The world of investing can be complex and unpredictable, with various factors influencing the performance of different asset classes. One of the most significant factors that can affect bond investments is interest rates. In recent years, interest rates have been at historic lows, making bonds an attractive investment option for many investors seeking steady returns. However, this situation is expected to change soon as renowned investor Warren Buffett has issued a warning to bond investors about the coming interest rate rise. In this video, we will delve into Warren Buffett's thoughts on the implications of the upcoming interest rate hike for bond investors and explore ways in which they can prepare themselves for the change. Firstly, we will define the concept of interest rates and explain how they affect bond investments. We will then delve into why Warren Buffett is warning about the upcoming interest rate rise and what this means for bond investors. Lastly, we will offer some practical tips for bond investors to prepare themselves for this change, including considering short-term bonds instead of long-term bonds, looking for bonds with adjustable interest rates, diversifying their bond portfolio, and consulting with a financial advisor. As the saying goes, knowledge is power. By understanding the relationship between interest rates and bond investments, bond investors can make informed decisions to take proactive steps to prepare themselves for the upcoming interest rate rise. Let's explore this topic in more detail. To better understand why Warren Buffett's warning about the coming interest rate rise, it's important to first understand how interest rates affect bond investments. Interest rates refer to the cost of borrowing money and are set by the central banks, such as the Federal Reserve and the United States. When interest rates rise, bond prices tend to fall, and when interest rates fall, bond prices tend to rise. This inverse relationship between bond prices and interest rates is due to the fact that when interest rates increase, newer bonds will be issued with higher interest rates, making the older bonds with lower interest rates less attractive to investors. As a result, the demand for these older bonds decreases, causing their prices to fall. Conversely, when interest rates fall, the older bonds with higher interest rates become more attractive, leading to an increase in their prices. The relationship between bond prices and interest rates is important for bond investors to understand because it can have a significant impact on the value of their investments. When interest rates rise, bond investors may experience losses as the value of their existing bonds may decrease. This is because the value of a bond is based on its future cash flows, and higher interest rates mean those future cash flows are worth less in today's dollars. Warren Buffett is a legendary investor and the CEO of Berkshire Hathaway, one of the largest holding companies in the world. Buffett has warned about the coming interest rate rise and its potential impact on bond investors. Interest rates have been low for an extended period of time, but Buffett believes that a rise in interest rates is inevitable. The relationship between interest rates and bond prices is inverse, meaning that when the interest rates rise, bond prices fall and vice versa. Bond investors who have invested in long-term bonds with fixed interest rates may experience significant losses if interest rates rise. Buffett has cautioned investors to prepare for this change by adjusting their bond portfolios. Buffett's warning stems from the fact that the interest rates are currently at historic lows. When interest rates rise, the market value of fixed income securities falls. The longer the bond's maturity, the greater the potential price decline. This means that long-term bonds with fixed interest rates are most vulnerable to losses when interest rates rise. Investors who have invested in bond mutual funds may also be at risk because the fund manager may need to sell the bonds to meet redemption requests, resulting in a lower price for the remaining bond holdings. Therefore, investors should be cautious and take steps to prepare their bond portfolio for the coming interest rate rise. As Warren Buffett warns about the upcoming interest rate rise, bond investors may wonder what steps that they can take to prepare for this change. Here are some tips for bond investors to consider. A. Consider short-term bonds instead of long-term bonds. When interest rates rise, the value of existing bonds falls. Long-term bonds are more sensitive to changes in interest rates than short-term bonds. As a result, bond investors may want to consider the short-term bonds as a way to reduce the impact of rising interest rates on their bond portfolio. B. Look for bonds with adjustable interest rates. Some bonds have adjustable interest rates that can change over time in response to changes in interest rates. These bonds may provide some protection against rising interest rates as their interest payments can increase if interest rates rise. C. Diversify your bond portfolio. Diversification is key to managing risk in any investment portfolio. Bond investors should consider holding a variety of bonds with different maturities, credit ratings, and issuers. This can help reduce the impact of any single bond on the overall portfolio and potentially mitigate the risk of losses due to rising interest rates. D. Consult with a financial advisor. A financial advisor can help bond investors understand the potential impact of rising interest rates on their portfolio and develop a plan to mitigate risk. A financial advisor can also help investors identify bonds that may be more resilient to rising interest rates and provide guidance on how to rebalance their portfolio as needed. Overall, bond investors should not panic about the coming interest rate rise, but rather take steps to prepare their portfolio for potential changes. By considering short-term bonds, bonds with adjustable interest rates, diversifying their bond portfolio, and consulting with a financial advisor, bond investors may be better equipped to weather any changes in the interest rate environment.